Hello, and welcome to today's webinar on why might I invest. My name is Rohan Batra, and I am a financial wellbeing specialist here at Hargreaves Lansdown, and I will be taking this webinar series. So today, we'll just be starting off by considering why you might invest and what that might mean for you. So in the agenda, we'll discuss saving towards your goals, cash versus investing, investing within your pension, and the power of compounding. I expect this webinar will last in the region of 10 minutes. And whilst I do very much hope that you find this informative, please note that it should in no way be construed as personal financial advice. So saving towards your goals. The first thing here really is to set yourself manageable targets. So set short term, so anything up to 5 years, short term goals, medium term goals, that's 5 to 15 years, and long term goals, anything that you want to achieve in 15 years or more. And then you can follow that split with your existing and future savings so that you might save a portion of your total savings towards something that you want to achieve in the next 5 years, something to the next 10, 15, and then something towards your longer term goals. And it's just important to think about what your objectives are and allocate your total savings respectively. So consider the investment time frame, how long you're investing or saving for, and definitely ask for support if you need it. Now, one of the key things to start off considering is which is best, to save as cash or to invest. So saving as cash is definitely important. It's important to have an emergency fund, so that's 3 to 6 months worth of expenditure. So just to be clear on that, that's the amount of money that you actually spend, which is not necessarily the amount that you earn. And that any objective that you have that you want to achieve in less than 5 years should typically be saved as cash, because the value of investments can fall as well as rise, and you might want that security of that capital, as cash that is held in the bank accounts in bank accounts is typically covered by the Financial Services Compensation Scheme. Just bear in mind though that interest rates are low, and what that means is that you won't get a great return on your money by holding it as cash. So it is unlikely to beat the rate of inflation, which sees the price of goods and services rise over time. If you have longer term ambitions and financial goals, then that's where you might choose to invest instead. So that's for anything with a time horizon of 5 years or more. You may be choosing to invest for income, so that's so that you can generate an income, and that income could be in the form of profits from companies as dividends, which we'll certainly be coming back to in a few slides' time to explain. Or it could be in terms of getting interest being paid on your money. You could also invest to try and grow your money so that the capital value grows, or a combination of both. This is definitely a concept that we will be coming back to later on in this presentation and throughout the other presentations in this webinar series. By investing, there's a greater potential to get returns on your money. As we'll see in a moment, investing does tend to provide returns that do beat inflation. However, the capital is not secure. The value of those investments could fall as well as rise. So what happens to your pension, and why are we tying that in? Why are we tying your pension into this presentation? Well, your pension by default will typically be invested in the stock market. So even if you have never made active choices about investments before, that doesn't mean that you are not an investor, as you likely will be. That means that you typically will own shares in companies, and perhaps even companies that you use and are very well aware of. You may well lend out money as well and get interest rates back for that. So your pensions will grow when those companies grow. When they get a larger slice of the pie, then your pension value will grow as well. And if they make a profit, they may pay that out to your pension or to you in the form of a dividend. That is one way in which you can get a return on your investment. Your pension value will also grow when you receive interest. If you're lending your money out and getting an interest rate back for that, then that will also help your pension value grow. So let's take a look at how different assets have performed over the past 25 years. So at the bottom, we have cash. If you had £1,000 of cash in the bank 25 years ago, and you left it in the high street bank and got the amount of interest that you're used to getting from your high street banks, it would grow to, it's in the region of £1,400 today. So in nominal terms, it would have increased. But this next line here is inflation. If you had a basket of goods costing £1,000 25 years ago and tried to buy an equivalent basket of goods today, it would now cost you just shy of £2,000. So simply put, the money that you had in the bank would not buy you the same amount of stuff. So as I've already said, having cash is important, especially for those short-term goals, but it's perhaps not the best long-term store of wealth because inflation will erode the purchasing power of your money over time. So that's where we look to invest. And this red line here is gilts. Gilts are UK government bonds. And a bond is when you lend your money to a company, or in this case to the government, and they give you an interest rate back for that, as well as your money back, of course, when the bond matures. Now, the UK government is seen to be a very secure borrower. They have never defaulted on their obligations, and therefore they pay a relatively low interest rate because there's a little risk that you won't get your money back. The riskier the company or the government, the higher the interest rate they will typically pay. Nonetheless, as you'll note, this is not a completely smooth line. There certainly are some lumps and bumps within it, and so in the short term, it is still possible to make a loss. With bonds, because you know how much you're expecting to get back, the money can't grow unchecked. There is a limit to the amount that a bond is worth. But over the long term, you can see that you would be able to buy double the amount of stuff that you were able to buy 25 years ago had you put your money into a gilt tracker and stayed the course. This next line here is shares. This is a measure of how the UK stock market has performed over the past 25 years. It's the most volatile line. It's got some fairly significant drops within it. You can see the dot-com bubble in about 2002, financial crisis bottoming out in 2008, and you can see an incredibly sharp drop more recently with the coronavirus pandemic. Now, shares are when you own a small slice of a company, and as I say, when that company is doing well, people will buy its products and services, and the share price will go up. Of course, if people are not buying that company's products and services, the share prices will go down. Share prices can fall to nothing if the company becomes worthless. Equally, though, there's no limit on the amount that they can grow to. So there is a greater potential for growth with shares than there are with the other assets on your screen here. Over the long term, shares have outperformed all other asset classes. However, they are riskier. You can see that those drops are quite significant. So there is a question as to how much you should of your overall investments should be put into shares. So let's go through shares and bonds in a little bit more detail. So shares, what affects their price? So you've got one company, a public limited company, PLC, and it's broken up into little segments. And then when people are buying that products and services, those shares, they grow, they become more valuable, and equally, they can shrink as well. So why do share prices fall? So if the company can no longer generate the same amount of profit, the same amount of income that it used to generate, then the share price will fall. If the market changes, if people start to believe that that company's products and services won't be needed in the future, or a new competitor comes on the scene, again, that will erode that company's sort of dominance, and that can shrink the share price. And finally, uncertainty in the market can cause people to or investors to move away from specific shares. And things such as Brexit did cause uncertainty and did affect a number of companies' share prices. So these are broadly, very broadly, reasons that company valuations can fall and therefore share prices can fall. The next is a bond. So I know I've been over this really briefly a moment ago, but it's really important that we do understand these key concepts. How does it work? So you've got yourself as the investor puts the money in the bank. The bank will pay interest back to the investor, but how does the bank do that? Well, the bank in turn loans money to a company, and when that company repays their loan, they'll pay interest to the bank, and part of that is passed on to you. What is that company doing with the money? Well, they're hopefully investing that, building their company, their brand, and they are generating income and profits from that they're using to pay off the interest and the loan. So what is a bond then? Well, a bond cuts out the middleman, cuts out the bank, and you're lending your money directly to the company instead, or to the government, as could be the case, and they're going to pay you the interest and the loan back directly. What's the advantage to you? Well, you typically get a higher interest rate than you would do from your high street bank, and the company, on the other hand, pays a lower rate of interest than they would have done to the bank. So you're cutting out the middleman, and both of you do tend to win here, provided that the company can pay back the amount that it has borrowed. So the topic of this presentation today is why invest. I've explained how different assets do work and how that might how they might fit into your portfolio, albeit very briefly, as that will be gone into in more detail in the rest of these presentations. But here, let's show you the impact of good performance. So let's look at £30,000 invested for 30 years net of charges. If you achieved 1% growth each year and that compounded up, you would get just shy of £40,500. If you achieved 4% growth, you would get in excess of £97,000. And if you achieved 7% growth, in excess of £228,000. So clearly getting a better rate of return is going to get you or put you in a better position in the future with your investments than you would have been able to achieve otherwise. Now, you can invest that however you see fit, and some of the assets that we've discussed so far today, shares and bonds specifically, are going to get you those growth rates. And in the rest of these webinars, we'll be giving you some tools so that you can choose the right investments for yourself. And this screen here should hopefully show you the reasons for investing for the long term. The other thing to note is the importance of the impact of starting early. So if you were investing to saving £24,000 over different lengths of time, you can see here how much you would generate as a return. So if you just invested £24,000 over 5 years and got 5% investment growth on that, then you would get about £27,000. If that same sum of money, £24,000, was invested over a longer period of time, so over many more months, making it much more manageable over 15 years, then even though you've only invested the same amount of money, because you've been drip feeding in for longer, it would grow or have time to grow by a significant amount more and would grow to in excess of £35,000. And again, finally, if you invested £24,000 over 25 years, drip feeding that in each month, or a portion of that in each month, then you would have even more time for growth, and that money would have grown to in excess of £45,000. So investing money is important, but it's also really important to give it ample opportunity in time to grow. So the impact of starting early, as you can see here, is quite significant. Even if you're investing the same amount of money several years down the track, if you'd started earlier in smaller bite-sized chunks, then you would end up with a better return, all things being equal. So in summary, there are 3 things that I hope you will consider when thinking about investing. Think about what your savings goals are. Think about how long until you want to access that money, and then should you be saving as cash or investing? And finally, Are you comfortable with the risks associated with holding it as cash or investing it? And is there anything that you can do to adjust that? These are definitely 3 key themes that will be coming up throughout all of these webinars. So at Hargreaves Lansdown, we do offer a whole host of services, and everything that we cover today is just as applicable to any part of our service. So we offer pensions, stocks and shares ISAs, lifetime ISAs and fund and share accounts, all available within one portal and with a wide variety of investment choices and options. Should you need any help, do feel free to contact us. We have an excellent section on our website, the Learn section, which will help educate you on how to make your own well-informed decisions. You can monitor your investments via the app. You can email us and phone us with any questions that you may have. Thank you for listening in today. Please do take a few moments to read through these important investment notes, and of course, use those contact details to let us know if you have any questions.